Hey everyone, Logan Hertz here with Hazeltine LLC. We have with me here again Peter Nelson of Nelson Insurance Advisors. Peter, how you doing?
Living the dream, Logan, living the dream.
So today we're going to talk about an estate tax strategies. So for those of you who either have an estate tax problem or might have an estate tax problem at some point in the future, we're going to talk about a brilliant and simple estate tax strategy that will enable you to alleviate or completely avoid paying estate taxes. And it's an adaptation of a fairly standard strategy that uses whole life insurance. Whole life insurance is one of the most ideal estate planning tools out there. So let me go ahead and hand it over to Peter since I learned about this from him. Peter, you want to walk us through, first of all, what estate tax is, who might be liable, and then how we could potentially mitigate it?
Yeah. Thank you for having me on, Logan. So first of all, right now the estate tax, I'm not going to get into specific numbers, but it's over $20 million for a couple right now. So the average American, if estate tax rates stay where they're at, or there's even been talk of actually getting rid of the estate tax, it's probably not an issue for the average American. But there are Americans out there, of course, that may go over that threshold and could create some issues. I learned this strategy from Tom Hegna.
So the estate tax is when you die, the total value of your estate might be taxed. There's a certain amount that's exempt from estate tax. I believe it's a little under 14 million for an individual, potentially double that for a married couple. Let's say you're a married couple and the estate tax exemption, we'll just say is 25 million for round numbers. It's a little different from that. If you die and your estate is worth 30 million, right? That means 5 million of that would be subject to the estate tax, which is currently 40%. Is that right, Peter? It's a pretty significant chunk of change that would then go to
Correct.
the IRS.
Correct. Yep.
So, just in case people don't know what the estate tax is, just wanted to explain that. Yeah.
Yeah. A lot of people that are in that situation, they probably know about it or they think about it in the back of their head. But the question comes down to is, are you going to worry about this when you get till you're, say, 70 years old, or are you going to get a hold of this beforehand? I say 70 because that's really why I think when people start thinking about this in the back of their head, and this strategy would still work for a 70-year-old. Okay. And you
Yeah. You
mentioned
want to think about not what is your estate worth today, but what's it going to be worth when you pass away.
Ed Slott talks about that all the time. And by the way, you mentioned whole life. Whole life is a great solution for part of this strategy. But if you really think about what I'm going to mention here, it doesn't matter the type of life insurance as long as the life insurance is there, because life insurance is part of this, and get the most effective and efficient policy. So you're trying to buy the most death benefit for the lowest cost. We're just trying to buy the most death benefit. So, in a nutshell, what you would do is, and I'm just going to use an example here for someone that was 70 years old. And let's just say they were getting close to, say, the $20 million mark, and they were getting concerned about it. Is we take a chunk of their money, we put it into what's called a SPIA, a single premium immediate annuity, and we're going to do a life only option. You're going to put, I just use an example of $10 million, dump it into the SPIA. Now, someone's going to say right away, you're going to put $10 million into a SPIA. Yeah, because it's going to pay out a large monthly amount of income or annual, whatever. And the whole point is that you're going to get this income to fund this life insurance policy. And then the minute you die, all the money is gone. And you say that's a terrible idea. No, it's not. All that money is immediately gone and out of your estate. And the life insurance policy is put into an irrevocable life insurance trust that immediately at death pops up and replaces, say it was $10 million, there would instantly be a tax-free death benefit of $10 million outside of the estate.
Exactly. So, what we're doing is step one actually solves your estate tax problem, but it creates another problem. So step one is we take whatever money you feel is at risk of the estate tax, $10 million, whatever the number is. And we take that and we purchase a SPIA, a single premium immediate annuity. So
Right.
right there, we've already solved your estate tax problem because that $10 million is now well and truly gone. You didn't invest it. There's no death benefit on that SPIA. You traded a lump sum of money for an income annuity. So now what happens is your net worth just dropped by 10 million. So now you're under the estate tax exemption. And in return, you now receive a guaranteed annual income for the rest of your life. Okay. If we stop there, the problem is, okay, I've gotten rid of my estate tax problem, but I just created another problem, which is what if I die tomorrow? That $10 million is now well and truly gone. That's the only way this works. It has to be well and truly gone, or else you're still subject to the estate tax. So, how do we address that? Well, that single premium immediate annuity is going to be paying you a significant amount of income. We're not going into numbers here, but it'll be some guaranteed income for the rest of your life.
I
A
have,
portion of that, go ahead.
do you want me to, I just ran quick and I don't want anybody to, they're just rough numbers I ran for a
Right. Yeah.
7-year-old.
Everyone always
You,
takes numbers as gospel, but let's go ahead if you have some. Sure.
uh,
Everything here is subject to change, subject to your personal
yeah,
situation,
yeah,
etc. This is just an
yeah.
example. Yeah.
So I just ran a really good SPIA with one of our fraternals. It's gonna 10 million at a 70-year-old would create about $523,200 a year of income.
Okay. So you gave up $10 million to purchase an annual $523,000 income. Okay. But
Yeah.
about half a million in income. Okay. Plus, you still have the remainder of your estate. We didn't take all of your estate, just the part that was going to be potentially above the estate tax exclusion. Okay. And so now the problem is if you die tomorrow, all that money that we moved out of your estate or that we used to purchase the annuity is well and truly gone. There's no death benefit on that annuity. Otherwise, this wouldn't work. Then it would just go right back into your estate and suffer the estate tax. How do we address that problem that we've just created? Because now that money is well and truly gone. Well, of that income, you can hopefully live off of a portion of it plus the remainder of your estate that you have left, which will be pretty significant. We're going to take a portion of that income and use it to fund a permanent life insurance policy with a $10 million death benefit. Okay. So now, when you die, a $10 million death benefit will pay out. Now we just recreated the problem we set out to solve, right? We solved your estate tax problem when we purchased the annuity, and then we added it right back in when we purchased that life insurance policy. Because if we just left it at that, then you die. That $10 million death benefit is now included in your estate, and you have the same problem. So that brings in the third part of the strategy, which is pretty standard and accepted, which is you take that life insurance policy and you move it into what's called an ILIT, an irrevocable life insurance trust. And now that $10 million death benefit is well and truly outside of your estate. That's why it has to be an irrevocable trust. You can set up the trust according to your liking, but once the policy moves into that trust, it's now well and truly outside of your control. You can
Yep.
have rules and trustees set up governing it, but you can have no direct control over it, no direct access to the cash value, which is why the policy is structured for death benefit typically, not for cash value, because you're not going to be accessing it. And now what happens is when you die, 100% of that death benefit is in the trust and it's going to be distributed according to your wishes and none of it will go to the IRS. So there you
That's
go.
a
So that 3-step strategy solves your estate tax problem. And the brilliant thing about it too, first of all, it's simple. It's a relatively simple, easy to set up strategy. We're using very guaranteed, simple tools like permanent life insurance and a SPIA, single premium immediate annuity. And we can repeat it. So let's say you have a good problem where I'm doing really well and the value of my estate keeps growing, and now I have an estate tax problem again. We can rinse and repeat, do the exact same process, and move
if
that money out of your estate.
as long as of course the person has their health. The first step of this would be to put them through underwriting for the life insurance because this whole thing doesn't work if you can't get approved for the life insurance.
That's a great point, Peter. This is why I think convertible term life insurance is so important. People oftentimes who have higher net worths might say, well, I don't need, quote unquote, that much death benefit in a convertible term life insurance policy. What if you start to have an estate tax problem? And by the time you realize you have an estate tax problem, you're not insurable anymore. Then you really couldn't do this strategy. But if you had a convertible term policy already in force, then we could simply convert that term policy to a permanent policy and use it for this strategy, right, Peter?
Right. And by the way, one of our companies that we just did a webinar on with their term product that is so flexible, this would be exceptionally handy to have something like that, that you have a term product that's convertible to age 85.
Correct. Yeah. Optionality. It gives you unlimited optionality. Yeah. So that's the very simple strategy. I think most people who work, very hard to build up a high net worth don't want the IRS to be the primary beneficiary of their estate. That's probably not why they built up all of those assets. And the nice thing about the trust too is that it in a good way forces you to do estate planning that you probably should have done to make sure that those death benefit proceeds are spent and utilized the way you want them to be spent and utilized. As an example, you can do what the Rockefellers do and make sure that the death benefit proceeds go into the next generation of life insurance policies to continue your family banking system and keep it all protected in the trust so it keeps earning and your heirs can have access to it, but it's not going to be wasted.
And it's going to provide liquidity when they need it the most. That's the issue I see doing this as long as I have. That's one of the biggest issues at time of death is creating that liquidity for the estate. All
Yeah,
we need is
death is unfortunately expensive. Unfortunately, death is expensive.
all we need is a death certificate and a couple forms filled out, and we can have it paid out in a week or two. No, that thing will pay out pretty darn quick.
So that's Peter's, and it's not original with him, but that's the super simple, super easy estate tax strategy. It's as simple as it is brilliant. So if you have an estate tax problem, or if you're worried that you might have an estate tax problem at some point in the future, you can come and talk to either Peter or myself. We can help you set up this strategy, or even if we don't need it today, we can at least plan for it by, as an example, having some convertible term in force so that
Bingo.
you will at least have the option to do this. Because if you think about what your estate might grow to over the next 20, 30 years, that it can, if you play your cards right, hopefully, I want everyone to have this problem. This is a good problem to have. I want all of our clients to have an estate tax problem.
Yeah, and somebody might say, if I do this now, what happens if they change the estate tax laws? Guess what? It's not like you don't have the income. It's not like you don't have the trust already set up.
Correct. Yeah, I wouldn't view this as being a mistake if they were to change the estate tax exemption and say, now everything up to 100 million is exempt from estate tax, so we're getting rid of it altogether. Okay, but you still set up a really good trust for your beneficiaries. You still have income to live off of. To your point, Peter, it's not like the money that we use, that net worth just went poof and disappeared. No, it's still there and it's not exactly under your control, but you set up the method by which it goes to the next generation and you still have the income from that annuity that you're benefiting from.
Right.
Let me point out one thing. My understanding is, now I'm not an estate planning attorney, so take this with a grain of salt. When we set up the irrevocable life insurance trust, you can set it up such that there is a back door where you can get access to it. Now, if you did that, it would come back into your estate. So you wouldn't want to do that. But it could be there in case something like that were to happen. So if you said, oh, now I don't have an estate tax problem, which could be the government deciding to get rid of the estate tax, or it could be something negative happens to you and your net worth just went to zero. You can access the funds through the back door. The only drawback is now it's back in your estate, which might be okay depending on where you are. So I'm pretty sure with a standard irrevocable life insurance trust, there is a way for you to get access. But if you do that, then it's back in your estate. So you wouldn't want to do that unless there is a specific reason where you don't have an estate tax issue anymore.
We do have some amazing advanced planning people on the back end. They've got all the law degrees and all that stuff. So when we get into that situation, that's where we bring in the advanced planning people and get a team together. And this is not
Correct.
something, even though this is a very simple strategy, it doesn't mean that we don't do our due diligence and make sure we're
Correct.
doing it the right way. Okay.
Correct. We would have an estate planning attorney who would set up the trust. Peter and I would not do that. We have people that we partner with, some of whom I've already had on my show. We might even have a tax attorney involved. And for an experienced estate planning attorney, this is not anything that's difficult. This is something they do all day long. But definitely they would be the ones to sign off on that part of the strategy. I'm just giving my layman's understanding. Don't take it as gospel, and it's subject to change.
Yep.
Yep.
Yeah.
Okay, very good, Peter. So thanks so much for your time. Those of you who think you might have an estate planning or an estate tax issue, please come and talk to us. Or if you just want to do more basic estate planning, come talk to me. I do partner with people who do that. I think it's more helpful if you have a life insurance agent involved in the estate planning because there's almost always going to be a life insurance component to it. But obviously, I don't personally do the estate planning that you would work with an attorney to do.
Yep.
Cool. Thanks so much for your time, Peter, sharing this great strategy with us. As always, we greatly appreciate your time.
God bless. Godspeed.